In September 1929, Irving Fisher, then widely regarded as America's most respected economist, addressed a gathering of investors. He delivered a pronouncement that would irrevocably shatter his professional reputation. Stock prices, he declared, have reached what looks like a permanently high plateau. I do not feel there will be soon, if ever, a 50 or 60-point break from present levels. A mere 9 days later, the stock market catastrophically crashed. Within 3 agonizing years, stocks had plummeted, losing an astounding 89% of their value. A quarter of all Americans found themselves unemployed, and banks failed by the thousands, marking the grim onset of the Great Depression. Irving Fisher was by no means a fool. He was a distinguished Yale professor, a mathematical prodigy, and the pioneering founder of modern monetary theory. Yet, he committed one fatal error. He genuinely believed that this time, things were fundamentally different. He was convinced that emerging technologies like automobiles, radios, and widespread electricity had ushered in a new, permanent era of unparalleled prosperity. He reasoned that the traditional rules governing valuations and debt no longer applied, and that the market's trajectory could only be upward. He was catastrophically wrong. Here in 2025, we are once again hearing these exact same, chilling words. This time is different. AI has changed everything. Productivity is exploding. The Fed has everything under control. Stocks can only go up. The parallels between our current situation and that of 1929 are not merely subtle, they are screaming. We see margin debt reaching all-time highs, alongside burgeoning asset bubbles in stocks, real estate, and cryptocurrencies. Overconfidence is so pervasive that any mention of potential risk is met with outright derision. And perhaps most terrifyingly, we observe the same delayed crash psychology, where every market dip is immediately bought, and every warning sign is willfully ignored. Everyone, it seems, firmly believes they will exit the market just before it truly falls. In the next 10 minutes, I intend to meticulously lay out these precise parallels between 1929 and 2025. We will explore why the crash psychology remains identical, what the specific triggers were then and what they are now, and the projected timeline for when this current scenario might finally unravel. Because while the pattern never repeats itself exactly, it certainly rhymes. Let me begin by illustrating what 1929 truly looked like, because much of what you likely learned in school is, in fact, incorrect. You were taught that the crash was a sudden, unexpected event that seemingly came out of nowhere. That narrative is fundamentally false. The warning signs were conspicuously everywhere. People simply chose to disregard them. The 1920s earned their moniker as the Roaring Twenties for a very compelling reason. Following the end of World War I in 1918, America embarked on a decade of explosive, transformative growth. New technologies were rapidly reshaping daily life. Cars became commonplace, radios connected homes, refrigerators kept food fresh, and washing machines lightened household chores. Productivity was soaring to unprecedented levels, and corporate profits were consistently breaking records quarter after quarter. Naturally, the stock market mirrored this exuberance, ascending in a near-vertical trajectory. Between 1921 and 1929, the Dow Jones Industrial Average surged from a modest 63 points to a dizzying 381 points, representing an astonishing 500% gain in just 8 years. The financial media of the era widely heralded this as the new era, confidently asserting that the old economic cycles were defunct and that technology coupled with modern management had forged a path to permanent prosperity. Sound familiar? But beneath those optimistic headlines, something inherently dangerous was quietly accumulating. Debt, and more specifically, margin debt. In the 1920s, an investor could purchase stocks with as little as a 10% down payment. This meant that with just $1,000, one could effectively control $10,000 worth of stock. If the stock appreciated by 10%, you doubled your initial investment. However, if it declined by 10%, you lost everything. By 1929, margin debt had ballooned to an alarming $8.5 billion, representing nearly 10% of the entire U.S. GDP. Everyone, it seemed, was borrowing heavily to acquire stocks. They weren't truly investing. They were gambling with borrowed money. On September 3, 1929, the Dow reached its zenith at 381. Irving Fisher, as we noted, delivered his permanently high plateau prediction just 2 days later on September 5th. Immediately thereafter, subtle cracks began to appear in the economic facade. Steel production commenced to decline, car sales started to fall, and unemployment figures began to tick upward. Yet, the stock market continued its ascent, propelled by the collective conviction in this new era. This phenomenon perfectly illustrates what we call delayed crash psychology, a period where fundamental economic indicators deteriorate, but asset prices continue to rise, driven by sheer momentum and copious amounts of borrowed money, rather than any underlying intrinsic value. On October 24, 1929, forever etched in history as Black Thursday, the inevitable crash truly began. Margin calls flooded the market, forcing individuals who had borrowed extensively to purchase stocks to liquidate their holdings. This initial wave of selling triggered even more margin calls, leading to further forced selling, initiating a devastating, cascading collapse. Within a mere few hours, billions in wealth simply evaporated. But here's what is absolutely critical to grasp. Most people, including many experts, initially believed it was merely a correction, a temporary market dip. President Herbert Hoover himself went on the radio to reassure the nation, stating, "The fundamental business of the country is sound." Financial experts urged people to buy the dip. Many heeded this advice, and they were utterly destroyed, because this was not a correction. It was the genesis of a collapse that would relentlessly unfold over 3 brutal years. By 1932, the Dow had plunged from its peak of 381 points down to a mere 41 points, an 89% decline. This destruction didn't happen over days, it occurred over years. It was a slow, grinding, and utterly relentless annihilation of wealth. Banks failed en masse. A staggering 9,000 banks, approximately 40% of all banks in America, went under. Why? Because they had extended loans to stock speculators who, once the market collapsed, could not repay their debts. When the stocks plummeted, these loans defaulted, and the banks, in turn, failed. Unemployment skyrocketed, reaching 25%. 1 in every 4 American workers could not find a job, not due to laziness, but because the jobs simply ceased to exist. Foreclosures exploded, leading countless individuals to lose their homes, their farms, and everything they owned. Makeshift shantytowns, derisively called Hoovervilles, sprang up in every major city across the nation. The Great Depression dragged on for a full decade, from 1929 to 1939, finally ending only when World War II necessitated massive government spending. An entire generation was irrevocably scarred by this harrowing experience, and they all posed the same haunting question: how did we not see it coming? The answer is, they did see it. They just refused to believe it. Because this time, they were convinced, was different. Now, let me turn our attention to 2025 and illustrate precisely why these parallels are so terrifying. In 1929, margin debt represented a staggering 10% of the GDP. Today, official margin debt in U.S. stock accounts stands at approximately $800 billion. As of late 2024, this is about 3% of the GDP, seemingly lower than 1929. But here's the crucial catch. That figure accounts only for official margin debt. It explicitly excludes leveraged ETFs that employ 2x or 3x leverage, options trading, which is inherently leveraged by definition and has surged to record levels. Cryptocurrency trading on platforms offering 10x, 50x, or even 100x leverage, and the substantial volume of private credit and shadow banking lending against portfolios. When you aggregate all forms of leverage present in our financial system today, we are, in fact, at levels that equal or even exceed those seen in 1929. Retail investors, ordinary people, are utilizing leverage like never before. Think of platforms like Robinhood, the phenomenon of meme stocks, and the explosion in options trading. In 2021, during the infamous GameStop saga, retail investors were pouring billions into call options, a form of pure leverage, implicitly borrowing to amplify their potential gains. This reflects the exact same psychology prevalent in 1929, the ingrained belief that stocks can only ever go up, making borrowing to buy them seem like free money. Margin debt specifically spiked to an all-time record of $936 billion in 2021. While it has since declined to $800 billion, it remains at historically elevated levels. It is vital to note that every previous peak in margin debt has consistently preceded a major market crash: the 2000 dot-com bubble, the 2007 to 2008 financial crisis, and the 2021 meme stock peak. We are currently at the third highest margin debt level in recorded history. In 1929, the asset bubble was predominantly concentrated in stocks. Today, we are witnessing simultaneous bubbles inflating across multiple asset classes. The S&P 500 currently trades at a Shiller PE ratio of approximately 30, whereas the historical average is a mere 16. This means stocks are currently trading at nearly double their long-term average valuation. The only other times this ratio has been higher were in 1929, 2000, and 2021. We are essentially at 1,929 valuation levels right now. Furthermore, the Magnificent Seven tech stocks collectively account for over 30% of the S&P 500's total market capitalization. This level of market concentration is higher than any point in history, with the sole exception of the dot-com peak in 2000. If these 7 bellwether stocks falter, the entire market is poised to fall. Home prices, when measured relative to income, are at their highest level ever recorded, even surpassing the peak of the 2006 housing bubble. The median home price is now 7.5 times the median household income, significantly higher than the historical average of 3 to 4 times. Bitcoin, Ethereum, and thousands of other cryptocurrencies have collectively spawned a market exceeding $2 trillion, a market with zero intrinsic value, generating no cash flows, and existing purely on the whims of speculation. This is not just one bubble. It is the everything bubble. Stocks, housing, crypto, private equity, all simultaneously inflated. In 1929, they only had stocks. We currently have at least 4 distinct asset classes firmly in bubble territory. In 1929, the prevailing narrative was that technology has changed everything. Automobiles, radios, and electricity were profoundly transforming American life. Productivity was soaring, and therefore, the old rules simply no longer applied. Today, the narrative is chillingly identical. AI has changed everything. We're entering a new era of unprecedented productivity. The old valuation models simply don't apply to these groundbreaking tech companies. This is arguably the most dangerous parallel, precisely because it is psychological. In 1929, anyone who dared to warn about excessive valuations was summarily dismissed as old-fashioned, as someone who failed to grasp the nuances of the new era. Today, if you voice concerns about valuations, you're promptly told that you don't understand exponential growth or don't understand AI. The specific language may differ, but the underlying psychology is absolutely identical. Consider this direct quote from John J. Raskob, a prominent General Motors executive in 1929. "Everybody ought to be rich. A man who saves $15 a week and invests in good common stocks will be worth $80,000 in 20 years. Compare that to today's ubiquitous crypto influencers. Just buy Bitcoin and hold. You'll be rich in 10 years. It's the exact same pervasive overconfidence, the exact same seductive promise of effortless wealth. And this brings us to what I believe is the single most dangerous parallel: delayed crash psychology. In 1929, there were clear, unmistakable warning signs for months before the actual market crash. Steel production peaked in June 1929, 3 months prior. Car sales began their decline in early 1929. Building permits fell, and unemployment figures started to tick up. Yet, the stock market continued its relentless rise. Why? Because of momentum. Because everyone firmly believed that stocks could only go up. Because every single dip was aggressively bought. Today, we are observing the exact same disconcerting pattern. Corporate earnings growth has demonstrably slowed. Consumer debt is at all-time highs, with credit card debt exceeding $1 trillion, student loans at $1.7 trillion, and auto loans reaching new records. Savings rates have collapsed to less than 4% of income. Yet, the stock market remains stubbornly near all-time highs. This stark divergence between weakening economic fundamentals and inflated asset prices is the undeniable warning sign. And just like in 1929, every dip is being bought. Every minor correction is met with an aggressive by the dip mentality. The prevailing psychology is that the Fed won't let markets fall. Stocks only go up. You can't time the market. And just stay invested. These mantras, while generally true in normal, healthy market conditions, become absolute suicide when you are squarely in the midst of a speculative bubble. Because in 1929, those who bought the dip in October ultimately lost everything by 1932. The dip kept dipping for a horrifying 3 years. Allow me to detail the exact mechanism of how the 1929 crash unfolded, because understanding this sequence of events is crucial for recognizing what to watch for now. First, there was peak confidence in September 1929. Markets were at all-time highs. Experts were confidently declaring a new era. Margin debt was at record levels, and everyone was overwhelmingly bullish. Then came the crack on October 24th, Black Thursday. A seemingly minor piece of negative news, a reported decline in steel production, triggered an initial wave of selling. This initial selling swiftly led to margin calls, forcing people who had borrowed extensively to buy stocks to liquidate their positions. This escalated into the cascade on October 28th and 29th. Forced selling triggered even more margin calls, and those margin calls, in turn, triggered yet more forced selling. This created a relentless, self-reinforcing feedback loop. Panic quickly set in, and everyone rushed for the exit simultaneously, only to find there were virtually no buyers. Prices went into a freefall. Then came the rally in November. After the initial, violent crash, markets surprisingly rallied by about 20%. Everyone believed the worst was over. Experts confidently declared that the bottom is in. People, relieved and optimistic, began to buy back into the market. This, ominously, was the bull trap, the deadliest phase for many. Next was the grinding decline from 1930 to 1932. The post-crash rally ultimately failed. Markets began to decline again, but this time slowly, agonizingly, grinding lower. It wasn't a single, sharp crash, but rather a prolonged series of lower highs and lower lows that unfolded over years. Anyone who bought into that deceptive rally ultimately lost everything. Finally, there was the economic collapse from 1930 to 1933. The stock market collapse decimated household wealth. This destruction of wealth led to a drastic reduction in consumer spending. Less spending meant companies were forced to lay off workers. Unemployment skyrocketed, leading to more defaults on loans. These defaults, in turn, triggered widespread bank failures. The failure of banks destroyed even more wealth, completing a devastating doom loop. Based on this historical 1929 pattern and current economic indicators, here is the most likely timeline for what lies ahead. Right now, in 2025, we are experiencing peak overconfidence. Margin debt is elevated, valuations are extreme, warning signs are increasingly appearing but are being systematically ignored. Markets are still rising primarily on momentum. Sometime in 2025 to 2026, the crack will happen. A trigger event could be a major bank failure, a significant geopolitical crisis, an inflation spike forcing the Federal Reserve to aggressively raise interest rates, a major corporate bankruptcy, or a debt ceiling crisis. Whatever the specific trigger, it will cause initial selling, margin calls will go out, and the cascade will begin. Then, from 2026 to 2027, we will see the crash and bull trap. Markets will fall rapidly by 30 to 40%. This rapid decline will then be followed by a deceptive rally of 15 to 20%. The media will declare that the bottom is in, and eager retail investors will buy back in. This, remember, is the trap. From 2027 to 2029, we will enter the grinding decline. Markets will fail to make new highs and will instead begin a slow, painful, relentless descent. Unemployment will steadily rise, corporate bankruptcies will accelerate, and the housing market will inevitably crash. Finally, from 2029 to 2031, we will reach the bottom. Markets will be down 60 to 70% from their peak. Unemployment could reach 15 to 20%. At this point, massive government intervention will become inevitable. It is crucial to emphasize that this timeline is not a precise prediction. It is, rather, a clear pattern recognition based on historical precedent. So what should you actually do right now? First, reduce your equity exposure. If you are currently 100% invested in stocks, move to a maximum of 50 to 60% in stocks. The remaining 40 to 50% should be held in cash, short-term U.S. Treasuries, or gold. Second, eliminate all margin and leverage. If you are using any borrowed money whatsoever to invest, pay it off now. Margin debt is precisely what annihilates portfolios in a market crash. Third, hold cash for the crash. When markets eventually fall 60%, that is when you should be buying. But you can only buy if you have readily available cash. Most people will be fully invested and completely unable to capitalize on the bottom. Fourth, own some gold. In the dark years between 1929 and 1933, gold was virtually the only asset that successfully held its value. While stocks plummeted by 89%, gold remained remarkably constant. Fifth, prepare for potential unemployment. Ensure you have 6 to 12 months of living expenses saved in an accessible emergency fund. The Great Depression put 25% of the workforce out of a job. Nobody thought it would happen to them. And finally, do not attempt to time the exact top. You won't succeed. Nobody does. Simply reduce your overall risk now, while things still appear relatively fine. It is far better to be a year early than a single day too late. In September 1929, Irving Fisher confidently declared that stocks had reached a permanently high plateau. 9 days later, the crash began. He lost his entire fortune, died in relative poverty, and spent the remainder of his life grappling with how he could have been so profoundly wrong. He was wrong because he genuinely believed that this time was different, that technology had fundamentally altered everything, and that the old rules no longer applied. He was wrong because he mistook a liquidity-driven speculative bubble for genuine, sustainable value creation. He was wrong because everyone around him was echoing the same sentiment, inadvertently creating an echo chamber of dangerous overconfidence. In 2025, we are once again hearing the exact same words. This time is different. AI changes everything. The Fed has our back. Stocks only go up. The leverage is the same. The overconfidence is the same. The delayed crash psychology is precisely the same. The only remaining question is one of timing. The 1929 crash did not occur because of a sudden influx of exceptionally bad news. It happened because the financial system was so excessively leveraged, so absurdly overvalued, and so inherently fragile that any minor piece of negative news could serve as a trigger for the inevitable cascade. We find ourselves in an identical position now. The system is fragile. Leverage is extreme. Valuations are absurd. Any trigger, and it goes. You cannot predict the specific trigger. You can only prepare for the ensuing cascade. The Great Depression taught us invaluable lessons. That markets can plummet by an astonishing 89%. That crashes can endure for years, not mere days. That buying the dip can utterly destroy you if you are premature. And that the individuals who ultimately survive and even thrive are those who proactively reduce their risk before the danger becomes painfully obvious. In 1929, they said it was different. It wasn't. In 2025, they are saying it again. It isn't. The pattern is a century old, and it is ominously poised to repeat itself. If this analysis has altered how you perceive 2025, I urge you to subscribe immediately. The next video will break down exactly which sectors are likely to crash first, which specific assets to acquire at the bottom of the market, and the precise signs that will signal the commencement of the cascade. The Great Depression 2.0 is not merely a prediction. It is a discernible pattern. And patterns, it is said, do not lie.